Hello, and welcome to American Riviera Bank's Regional Pulse. This is Paul Abramson, Chief Technology Officer at the bank. Today, we have Max Drucker with us to discuss how AI is transforming business on the Central Coast. Max is co-founder and CEO of Carpe Data, located in Santa Barbara, California, and Lisbon, Portugal, where he has led innovation for the insurance company as a data visionary for 2 decades. Prior to Carpe Data's launch in 2016, Max served as CEO of Social Intelligence, and prior to that, got his start as CIO and co-founder of eCoverage, the nation's first online auto insurance company. Thanks for joining us, Max.
It's great to be here.
So to get started, I think I wanted to just talk broadly about AI. It's obviously affecting a lot of different industries. And what do you see as the most significant change associated with the shift to AI over traditional models?
So for us here at Carpe Data, we look to leverage data and ultimately predictive models and AI and really all forms of AI to achieve one of 2 core use cases. It's either to automate processes, and there's a lot of manual tasks and processes that currently exist in the property and casualty insurance industry where we are today, and also to improve insurance outcomes. How do we identify where there's fraud? How do we identify where there's loss going to be? And how do we really make sure that the insurer is getting the outcome that they expect? So AI is an entirely brave new world and really exciting to be able to really predict these kinds of outcomes. And there's really a long way to go before aren't people involved in the process. So I think that the exciting and really positive changes is that these new technologies, this new data, and these new approaches are enabling insurers to continue to grow and scale without having to necessarily replace their workforce. One of the challenges they've seen is an incredibly tight labor market over the last several years, and only promises to get worse as younger people are not going into these industries. And so the timing is really quite perfect as people are beginning to retire, and now we have these new technologies to be able to pick up some of the pieces of those tasks.
Cool. That's actually sort of leads into the next question that I had. I have some friends that are actuaries, and I know that this type of technology is going to have a pretty tremendous impact on that job sector. How do you see those jobs changing?
I think the jobs are changing already. And I think that the overlap and blur between what's quote unquote data science and actuarial has already begun. But they really are in many ways very, very different. But if you think about insurance carriers, they've really been the original companies in doing predictive analytics. They've been predicting outcomes for literally centuries based on mortality tables or based on agricultural tables. And so we think of over time, insurance has been something in which basically one side is protecting people or taking the risk of the other side of it. So there's really that perception of them being very, very slow and very behind. But in this particular area, in predicting outcomes, they've really been quite ahead of the curve. And I do think that so much of how the regulatory environment goes and how slow it is to change, it will, again, be a very long time before pure data science models, and certainly models that don't necessarily, regulators want to see it being causal. They want to see that this action creates this kind of an outcome. Often with AI, it can be a black box, and that can be a lot more difficult. And so until we can really get there in various models, there'll still be a very big need for the traditional methods of actuarial science.
That makes sense. It's interesting too. I sort of think of banking in the same way that you described insurance. It's like one of the, older industries, but yeah, technology, kind of keeps it interesting over time. You also sort of led into one of my other questions is what do you anticipate that regulatory framework when it finally does catch up to look like?
Well, the regulators need to understand what's going into these models. And so the regulators in the insurance space really have been making a lot of investments into AI and big data and really trying to understand and being able to basically keep up with the big companies and the big data scientists and massive investments that go into it. And sometimes insurance filings can have thousands of pages in them, and it can be very difficult for the regulators to really understand exactly what's going into those. But ultimately, and it will vary state by state, but ultimately, the regulators need to be able to understand why is this outcome supposed to happen, and they need to be able to really show that correlation. But again, it's really, the regulators are much more eager to see what's causal. It was whether that the driving behavior is predictive of some sort of negative outcome or some sort of geographical situation is going to be predictive of some sort of more risk than other areas. They want to see things like that and less about, well, the model correlates. And so therefore, this is why they should be entitled to be able to allow this to happen. And so it's definitely a game of cat and mouse. But in the end, the insurers will need to be able to demonstrate what justify whatever that price is.
That's interesting. So outside of opening up the black box, how do you think that's actually how are you going to prove it?
Well, I mean, there's a number of methods in which they can do that. But an area that is become common in a lot more states, there was actually a really interesting story in the New York Times about this yesterday. But usage-based insurance is a really good example of ways that insurers can predict outcomes. And so they can prove that drivers that accelerate more quickly or that do hard braking or cornering or drive at certain times of the day or drive at or speed are indeed more likely to have losses and have accidents. And that can be demonstrated very simply via the data that shows that. And so insurers really want to be able to use that type of data. And regulators like it when they're using that kind of data because these are things that people have control over. And insurers are really looking for things that people can do something about. And so if they have driving habits that can be proven to make them at greater risk of an accident, well, if they change their driving habits, they're going to be less likely to have those accidents. And that's good for really all parties involved. And it's one of the reasons why in a place like California, insurers, and in a trend happening in a lot of other states as well, are very opposed to using methods like credit scores, which may be predictive, may correlate towards loss, yet they aren't necessarily causal towards those losses. And people don't necessarily have control over their credit. There may have been a medical bankruptcy or many other things that drive a disparate impact and then cause higher insurance rates. So the trend is without a doubt moving towards areas in which the insurer must prove that this type of behavior results in this type of an outcome.
That's interesting. How do you think it's going to evolve with the kind of autonomous driving technology? Do you think we're going to get to a point where, companies like yours are evaluating the quality of one manufacturer or another and maybe, providing discounts and insurance if for the longer somebody has their car in autonomous mode, things like that?
Well, I think if you'd asked me 6 or 7 years ago, I would have thought by now there wouldn't even be personal auto insurance anymore. And that basically it'd be product insurance, just like you have product insurance on some appliance that you buy. Your car would effectively be insured by the manufacturer. And so the car manufacturer would be getting insurance from whether the big insurance carriers, and it might vary based on what the historical accidents have been on those autonomous cars. But it would no longer be about the individual because the individual would no longer really have a role in what these things happening are. I think if we fast forward to today, it's hard to see a clear path of when people are no longer driving their cars and we're seeing really fully autonomous cars in the roads, and the liability is entirely on the carrier side. That said, now with companies like BMW and Mercedes, they both have level 3 products. And they carry the liability up to, I think, about 35 or 40 miles an hour when you're in that mode, which is on the highway. So certainly it's coming. When that's coming is really hard to say. But absolutely that will be the trend, is that the individual will no longer carry that kind of personal insurance, and it will just simply be part of what they're getting when they buy that car, and because it will not be within their control.
And so do you see that as like a potential revenue stream for the auto manufacturers too?
Probably not. I think it's better for all parties because the whole point of autonomous cars is, or at least the sales pitch at least, is that it's safer. And that means fewer accidents or no accidents. And I think that, current casualties today are very significant, which cause great loss in both dollars and in every other way. But also fender benders and accidents are very, very, very costly. And so our regulators are not going to let us move to a world of autonomous driving until it's far, far safer than humans are today. And so that just means the exposure will go way down. And so the amount that needs to be insured will go way down. And so it'll be really a very positive economic outcome for consumers. Maybe not for the insurance carriers, but for the consumers.
Well, I'm looking forward to that. Okay. One of the things that I find really interesting about, some of the advances in AI is the sort of things that the AI sees that maybe humans didn't. In your experience, what have been some of the more interesting and unexpected insights that the AI has provided?
Well, for us, one of the things that Carpe Data does is we look at businesses and we help insurers assess risk and really likelihood of a loss based on the presence of that business. And that can be the online presence of the business. That can be the customer ratings or reviews of this business. Really anything we can learn about that business, that will go into some kind of a model. And it can both look at historical losses. But what's really interesting and exciting is that using these newer AI technologies, so by using the large language models, we're able to look at the last 5 years of reviews or customer comments or what people are talking about a given business. And sometimes what you'll find in that business is people are talking about things that are likely to actually happen. People will be talking about there being a slippery section of the floor. And as it turns out, then losses do then occur. Or people will be talking about how much they dislike a parking lot because it's so dangerous. Well, lo and behold, those businesses are indeed more likely to have those losses. And so that can just be, it's really interesting to actually see how the expected and obvious actually plays out. Right. So it's not about the black box or the magic. It's really about way people saying this does actually indeed happen and validating that.
So it's more about kind of finding those little hidden gems in all of the background noise of the internet.
Right. And being able to just really analyze massive amounts of data that's unstructured and it's complex, and being able to surmise, okay, where can I identify a signal in this massive array of data that would be impossible for a human being to possibly analyze and weigh through themselves.
So that kind of leads into the last question that I had, and that's how do you decide what data sources you're using to look at, train your models, et cetera?
So a data company for insurance is going to be taking any data they can get, because insurers are always looking for new data elements to predict outcomes. Most of the data that they look at, they've been using for a long time, and they've been traditional methods. So the area that we focus largely on is the online presence, the internet, what exists out about potential insurance applicants, what about businesses, and what's out there. Because that data traditionally has been very difficult to put into structured formats or really surmise what's that specific signal. What is the specific thing I'm able to predict from the internet, if you will. And so for us and what we've done over these years is really about experimenting and looking about, does the reputation of a business predict some given outcomes? Does the online visibility of that business, what's that telling us? Can we identify what's different between these two businesses? How does this coffee shop compare to this coffee shop? They're different, and does that predict outcomes? And so, we are just scratching the surface on the power of the publicly available internet for data to predict outcomes.
Cool. So Max, outside of the insurance industry, how do you see businesses using AI more broadly?
So I think it's been really exciting, as we've seen in this past year since their real launch of OpenAI and ChatGPT. What we've seen has been possible with generative AI and large language models. And I generally like to refer it to as just better AI, right? We've really had a level up in capabilities. But I think the way I think about it being broadly used as businesses falls into one of three categories. I think the first place you want to think about is, how is the team internally leveraging these new technologies across the entire organization? So how is our marketing department using this to write new copy? How are we using this to create art? Are our developers using this using Copilot? Is our accounting team, how are they approaching this? Really, is our sales team getting help on writing their messaging? How are we leveraging these more generic new approaches across an organization to really get to best practice? So I think that's a really important piece to think about across the entire organization. how are we getting better? Because everyone else is, so we need to as well. I think the second category of using these new AI technologies is how do I reduce my COGS? How do I reduce my cost to make my given product? If I'm not able to understand how these new technologies reduce the cost of my products, well, somebody else is going to come along and cannibalize my business. So you need to be really on top of it, understanding how can we take costs out of what we're currently doing in order to get to whether that's being able to deliver more value or being able to reduce a price point, but really understand that how to avoid being disrupted using new technologies. And the third category that I think businesses want to be thinking about, and certainly the area that I find most interesting, is how can I use these new approaches to AI to do things that weren't previously possible, or certainly not possible at a price point that's now available or that can scale in the way that it's done today. So how can, in case of my business in creating data for insurance carriers, how can we predict new kinds of things? How can we produce new kinds of loss? What can we show them about a given business or an individual that they couldn't get to otherwise because of this new technology? And that's super interesting. And that's where we're seeing all of these new use cases. But that's the area that I know that we really try to challenge ourselves is what is possible now that wasn't possible yesterday.
That's super cool. Thank you. Well, I want to thank you so much for your time today, Max. And thank you to our listeners for joining us. To learn more about Carpe Data, visit their website at carpe.io. If you would like to learn more about American Riviera Bank, please visit us at arb.bank.